All right, let's talk about a headline that sounds like it's straight out of a movie, a trade war over Greenland. I know, it sounds kind of out there, but the fallout from this whole thing could actually be hitting your investment account as we speak.
It sounds just bizarre, right? How can an argument over a giant island of ice make Wall Street veterans start to panic? Well, the answer comes down to one really powerful, and let's be honest, very disruptive, economic weapon.
So what is actually going on here? Let's break down the news that's making the markets so jumpy.
It all kicks off with this pretty wild proposal. The United States literally offered to buy Greenland. Denmark said, no thanks, and in response, the US hinted at using some, let's call it economic pressure to make them reconsider. And that leads us to the one word that's really at the heart of the market's anxiety: tariffs.
And this threat, it isn't a one-and-done deal. It's actually designed to ramp things up. As you can see, on February 1st, a 10% tariff is set to hit 8 European countries. But the real deadline, the one everyone's watching, is June 1st. If there's no deal by then, those tariffs more than double to 25%. It's a classic ticking clock negotiation tactic. And yeah, that's what has investors so spooked.
And the reaction from the market? It was immediate. Right after the announcement, the S&P 500, which, is a huge benchmark for the entire US stock market, it drops by over 2%. That is a serious sell-off, and it was driven entirely by this news.
So, what we're seeing is this chain reaction of fear. The market isn't just reacting to the tariffs themselves, it's playing chess, thinking 3 moves ahead about all the dominoes that could fall. Higher costs for businesses? Well, that can lead to less spending, which then hurts profits, and that can put the brakes on the whole economy.
Okay, so is all this panic justified, or is this just a bad case of déjà vu for the market? To figure that out, we really need to look at a super similar situation that happened just last year. Check out this pattern from 2025. It starts with a big tariff announcement, and then, boom, an immediate market drop. Sound familiar? Because that's exactly where we are right now. But here's what happened last year. The tariffs got put on pause, and the market rallied right back. So the big question on every investor's mind is, are we just about to see the second half of this exact same script play out all over again?
This quote just nails the mindset of the investors who saw last year's panic as a chance to get in. You see, they weren't reacting to the fear itself, they were reacting to the discounts that the fear created in the market. It really shows the huge difference in how people can look at these exact same events.
And here's the proof in the pudding. Even though there were 3 different times the market freaked out over tariffs in early 2025, the stock market actually finished the year up by more than 16%. It's a really powerful reminder that scary headlines don't always tell you how the story's going to end.
Okay, so we've established that tariffs create fear, but let's get into the nitty-gritty. How does one single tariff actually send ripples through the entire global economy?
This cycle shows just how fast things can spin out of control. It starts at step 1. The US puts tariffs on goods from the EU. That makes everything more expensive. So, the logical next move, step 3, is for the EU to hit back with their own tariffs. And the result? US companies start selling less, their profits get squeezed, and that pain shows up right in their stock prices. It turns into a lose-lose really fast. Now, when fear takes over, you often see this flight to safety. This is a simple picture, but it gets the idea across. Money starts flowing out of assets that feel risky, like stocks, and into things that feel more stable, like gold. So what is it about gold that makes it the go-to safe place?
To really get the rush to gold, you kind of have to understand what our money actually is. The US dollar is a fiat currency. Now that's a fancy term, but all it means is that our money isn't backed by a physical thing like a vault full of gold. Its value comes from our collective faith and trust in the government that issues it. And when that faith gets a little shaken by economic chaos, some investors just want something tangible.
And this wobble in the dollar's value has real-world consequences for all of us. A weaker dollar means your purchasing power literally goes down. You know those imported avocados at the store? They get more expensive. Now, on the flip side, it makes stuff we export cheaper for other countries. But it's this instability in the very foundation of the economy that makes investors so incredibly nervous. So, this brings us to the most important question of all. How should you react to this? The key, really, is to shift your mindset from short-term panic to a long-term strategy. It really boils down to 2 different ways of thinking. On one side, you have the trader who's glued to the headlines, reacting to every little thing, usually selling low because they're scared. But on the other side, you have the long-term investor. They ignore the daily noise. They focus on their strategy, and they see a market dip not as a crisis, but as a potential sell.
A huge piece of that long-term strategy is real diversification. And that means a lot more than just owning a bunch of different stocks. It's about owning different types of assets. Things like real estate, stocks, and gold. They don't always move in the same direction at the same time. So when one of those is down, another might be holding steady or even be up. And that creates a buffer that protects you from the swings. Ultimately, it just comes down to these core ideas. The goal isn't to perfectly predict the daily headlines, it's to understand the bigger trends, to know what you're invested in and why you believe in it. And maybe most importantly of all, to not let fear be the one making your financial decisions.
And that leaves us with one final question to think about. As all these headlines about Greenland and tariffs and market craziness keep swirling around, what's the biggest risk to your long-term success? Is it what's happening out there in the economy, or is it how you choose to react to it?